What is an account? An account is a separate record for each type of asset, liability, owner equity, revenue, expense, and draw used to show the beginning balance and to record the increases and decreases for a period and the resulting ending balance at the end of the period. What are the types of accounts? Types of accounts are the balance sheet accounts, which include assets such as cash and inventory, liabilities such as accounts payable and loans payable, and owner's equity. We also have our income statement accounts, which include revenues such as our sales and expenses such as cost of sales. One other type of account is owner's draws that we use when the owners take money out of the business. A business uses records such as journals and ledgers for recording their transactions. What's a transaction? A transaction is any economic event that involves the exchange of goods, services, or money between two or more parties and can be measured in monetary terms. Recording transactions is based on the double-entry bookkeeping system, the accounting equation, and what are called debits and credits. Some examples of transactions are making a sale, getting a loan, and purchasing equipment and inventory. Double entry is a type of bookkeeping system that requires every transaction to be recorded in at least two places, accounts, using a debit and a credit. Debits and credits are used to record the increases and decreases to an account's balance. No bookkeeping system would be complete without report. A balance sheet reports what a business owns and owes to suppliers and the owners, while an income statement reports if the business is making any money.